I think this market this year has been captured by macro events. Macro by its nature are very hard to predict. No one predicted tanks would be moving in Ukraine. That has been really upset the apple cart for everybody. Food prices, oil prices, and so I think we are very much dependent on that next shoe to drop or not. I mean, the fact that China is looking like it's reopening will certainly reduce, I think, volatility and is a positive thing for markets. If the markets continue to avoid another drawdown, yes, I think volatility would decline, but I think there is a risk of another drawdown. I think for the first time in years, fixed income is suddenly a really attractive place to be. Certainly nominally, and as inflation begins to subside, I think a pretty compelling place. And so yields worst in high yield is high single digits, low double digits. That's pretty attractive and not going to last forever. So I think you're going to see people moving in. Look, we're seeing a lot of tax loss harvesting right now. We're seeing a lot of repositioning of portfolios, but my suspicion is if we don't see more inflationary impulses, we'll see more demand for fixed income than we've seen in a long time. You know, distress has been recently more episodic. In a more sustained downturn, there's could be really interesting opportunities, and CarVal is unusually well placed to capture them. They have a long, long track record of excellence, and so we're really excited to introduce that to our private wealth clients, as well as our institutional clients. And so that's one of the things we're thinking about as we enter into 2023. They are also a leader in clean energy. We're in the market with that now. So I continue to see a secular move into private credit, and we're really happy to be doing it with CarVal as our partner. Well, we've made a number of large strategic decisions for AllianceBernstein this year with the acquisition of CarVal, with the joint venture of Bernstein Research. We're going to spend a lot of time next year putting both of those things to bed. So that's what's keeping me awake at night and my team focused. But we're always looking for really talented investment teams. Those culturally are not disruptive, they're easily done, and the payback is really short. So we're one of the few places that's a great home for really talented equity and fixed income investors who are committed to active investing. So we want to zag when everyone is zigging. So we'll look for that, but those tend to be smaller, not big disruptive. I think if we head into a sustained recession, and I think we will go into a recession next year in the U.S., and Europe clearly already is in one, I think we're going to have to focus on that. We aren't immune to that. We're pro-cyclical. We're an asset management business. But we also know that the value of our firm are the people who work in it. So we're going to do whatever we have to do to protect them, but we're going to stretch out investments in other things that are priorities for us to do that. And we're going to, if we have to make tough decisions, which I think we might, we will do that. So yeah, it's been a hard year. On the other hand, we're blessed to be in this business. Our people are paid really well. And I think they should understand that in times like this, the take home, particularly of our higher paid people, is going to go down. And that's happening. I haven't seen real fee deterioration. I mean, we've been in a period of secular fee deterioration in liquid markets. I think that trend continues. I don't think that changes. I think it will impact margins. It has impacted margins this year. Our biggest expense is comp and benefits. And so it hasn't gone down as much as revenues have. So I think we, along with the rest of the industry, our margins have been hurt less than most of our peers, but we've all been impacted. I think we're going to have to get our expense base right. I think we need to stay true to our investment initiatives, whether it's our build out in China, whether it's continuing in our private credit business and continuing to look for really talented investment teams, and finally further building our private wealth business. I think all of those represent really exciting growth opportunities for the firm. The timetable may get extended to do those things, but putting aside others and making the decisions of what's essential versus what's nice to have, I think that's the critical question for us for 2020. Core is continuing the build out of our retail distribution, particularly in China. Nice to have would be to really build out in new regions of the world like Latin America, where we're not a significant player today. That would be an example of that. I think it starts when we begin to see meaningful refinancing challenges in the marketplace. We're already beginning to see that in commercial real estate. I think that's pretty clear, particularly in office. I think we're going to see that potentially, if this is a sustained downturn from lasting more than a quarter, which I think it could be. I think you could see that in corporates, in private credit. I think you could see it in some portions of the high yield market as well. So I think there could be opportunities. There already have been some. So we sit poised and patient, because I think patience is a really key issue here. Look, I think ultimately we have to see what happens in the broadly syndicated loan market. That's the underlying ingredient to the CLO business. And so far, it's been pretty painless. I think that could change, and we could see higher degrees of defaults and lower recoveries. But the market has reflected that. I mean, pricing has really changed in that marketplace, particularly for the more junior tranches. We've also seen lower demand. Some of the key buyers in AAA have stepped away. So that market's going to see much lower issuance, which is probably healthy for it. But we participate in those markets. We continue to look at them carefully, and we will selectively participate. Look, I think my worst-case scenario is the Fed doesn't step in, which I think is pretty much a given, absent a bank getting into trouble, which I think is unlikely. I think that if the recession, the Fed is going to have to break the wage cycle. If it significantly overshoots and we go into a deep recession that lasts several quarters, I think that could meaningfully impact credit quality. And a lot of people who have lent money have never been through a sustained cycle, so we don't know what the recovery rates are going to look like. So I think a lot of that's very hard to evaluate and probability weight right now. So those are the things we're looking at to see. I think you need to re-underwrite what you got. Make sure you see what the second way out. Make sure your covenant structure is really viable, that you're focused and have a deep understanding of what management strategy is, and you have confidence in their ability to execute it. It's not time to be complacent about that. I think our ability to generate positive flows in our traditional areas of strengths, whether that's equities and fixed income, continued growth of our private credit business, growth of our private wealth business. That's how they should measure us.